In this presentation, we will discuss an adjusting entry related to an invoice or accounts receivable or revenue, the problem being that the invoice had been entered into the system after the cutoff date in March when the work was actually done in February. Therefore, we need an adjusting entry to bring that income into the month of February before the cutoff date and bring the related accounts receivable into the proper period as well. Here we go with Xero. Here we are in our Get Great Guitars dashboard. We're going to be opening up our financial statements starting with the balance sheet by going to the accounting drop down, going on down to the balance sheet. When that opens up, we're going to go back up top as we will now, right click on it and duplicate that tab. We're going to do the same for the income statement. We're going to go back to the tab to the left. We're going to be opening up the income statement, going to the accounting drop down up top, down to the income statement. So we'll be opening up the income statement. I'm going to duplicate the tab for the income statement as well, right clicking on the tab up top, duplicating that tab. Now let's go to the balance sheet. Let's change the dates to the dates that we'll be working in on. We want the cutoff date being the end of February. So we'll change this to the end of February, February 29th. We'll update that report. And we'll do the same for the income statement. We're going to be updating that report for the end of February. It shouldn't matter because there's no data after that at this time, but we'll make an adjustment to that. So I'm going to make this as of the end of February. So there we have that. Now we're going to go back over to the balance sheet and we're going to consider our situation here. Now the situation is that we have an invoice that was implemented into the system, but it's going to be happening after the cutoff date, even though the work was done before it. To consider that, let's look at our flow chart. Now, this is probably most common in types of industries like a service industry where possibly you do the work and then you bill the client, like a law firm, or if you're talking about a accounting firm or possibly like landscaping or something. In our case, we can imagine the guitar lessons being taught by our instructors. We have to then count the items or the hours that were taught by the instructors in a similar fashion we would do for a law firm and whatnot, and then bill out at the hourly rate that we have charged for those instructors to the clients. That means that we would have the work be done in the past, then we'd have to take those hours and determine what the invoice amount will be and then send out those invoices. Therefore, the invoice, it will not be made possibly at the point in time the work was done, because we're going to have to get the time first and then do the invoice later. The system will record the invoice in there at the point in time we do the invoice, obviously, and record the accounts receivable and the income at that time. On an accrual basis, however, we need to pull that income back to the point in time the work was done. So for a service company, we would have that kind of situation where we would need to pull that in if it was something like a law firm and we had our billing that we did at a later point in time. If you're talking about someone has inventory, like selling our guitars, then it would be the point in time typically that we ship the guitars out, that we no longer have ownership of the guitars. They're now gone, they've been shipped. That's the point in time that we do the work. So if for some reason we didn't enter the invoice until after the guitar was shipped, like we shipped the guitar and then we entered the invoice, then again it would be in the following period and we need to pull it back. We're going to use that situation as if we had inventory with the guitar because it's going to be a bit more complicated because we have to deal with the inventory in that scenario. So what we're going to do is we're going to imagine that scenario where we entered the invoice in March after the cutoff date when we actually shipped the guitar in February. Then we'll need to do an adjusting entry for it. So in this presentation, what we'll do is we'll just enter the invoice after the cutoff date. So we'll see what the invoice looks like as it's entered in March, and then think about how we would then go in there and make an adjusting entry to basically pull that information into the month of February when the income was actually earned. So we're going to enter this invoice in. I'm just going to basically enter an invoice in March. So I'm going to go back over to the first tab. We're going to go to the accounting. We're going to go to the plus button over here. And then we're going to just enter a normal invoice as we have seen in the past. I'm going to enter it for Anderson. And I'm just going to enter it in March. Let's say March 10th. So I'm going to say it went out in March 10th, even though the guitar, for whatever reason, was shipped before in February. And this would be kind of more common if you were talking about, like I say, a billing type of situation, but the inventory adds that level of complexity. And I'll bring it all the way out to the 10th so that we have that kind of space between. Usually you would think it would only be a couple days, but I'll bring it out to the 10th so you can see kind of the space in there. So I'm going to bring it out there, and we're going to say that this is going to be an inventory item. We're going to sell an ELP. So an ELP, and we're saying that we'll just say that we sold one of those. So we got the 500, that comes out to the 547.50. What's this going to do? It's going to be our invoice, standard invoice. It's going to be increasing the accounts receivable by 547.50. However, in March, and we really would like it in February, because we're saying, again, we shipped this in February. And so that's going to be the problem. So but in March, it's going to be increasing AR, and then it's going to be increasing sales by the 500, the difference going to the sales tax payable, liability, 47.50, and of course, the inventory going down by some amount that's not on here, that's driven by this number, 400, I believe at this point. And then the other side going to cost of goods sold and expense account increasing. Let's check that out. We're going to save this and approve this. Except I need the due date here, so I'm going to say this is in April 10th. And then let's save it and see if it allows me to push forward here, if I did anything else wrong. See if it gives me a good green light. There it is, green light. All right, so now we're going to go and update our report. Now, nothing's going to happen in February, same numbers as of our cutoff date. Now we want to go to the end of March. Let's go to the end of March and update the report. And we'll see the effect of just this one invoice in there. And so we're going to go down and we're going to say that the accounts receivable should be increasing. So if I go into the AR, accounts receivable, and scroll down, we see the increase for the 547 in March. Then I'm going to go back to the trial balance and I'm going to go into the income statement where the other side is. Let's just look at March for this setting. Again, this is the one transaction in March. So we'll say March 1st through March 31st, update that report. Then we'll see an increase in the merchandise income of the 500. So that doesn't include the sales tax being the difference. That's going to be back on the balance sheet. So if we go then to the balance sheet, we're going to say in the liabilities section, there should be a liability that is increasing here for the sales tax payable will be in there. Then the inventory is going to go down. That's up top. So the inventory, if I select the inventory, it should be going down by, I believe, 400, an amount not on the invoice, but an amount that is driven by the invoice. Scrolling back down, 400 decrease there. And then if we go back to the income statement, we should see cost of goods sold increasing by the 400, the net change on the income statement from this invoice on the income statement, the net income effect, $100. Now what we're going to need to do is enter this as a journal entry. I don't want to redate the invoice because it might be connected to something else. So I don't want to adjust the invoice date. Like we could think, well, why don't I just adjust the invoice date till sometime? You could do that, but the invoice date might have some reason that it's going to be in there. It might be necessary to track when it's going to be paid. It might already been paid and whatnot by the time we're doing this. So we're going to keep the invoice in there as of where it is. We're going to enter this information then as of the cutoff date, meaning I got to get this income in before March or at the end of February. So I'm going to do that with a journal entry. So what we then need to do is think about, okay, what's the journal entry related to this invoice? Now, you might be asking, well, what if you do that? Then you're going to have it in there twice. And we will. As of February, we'll have it in there twice. And that's why we'll have to do, once again, a reversing entry. So we're going to do this to make it right. We're going to do an adjusting entry to make everything correct on an accrual basis as of the cutoff date, and then we'll reverse it when necessary. In this case, it will be necessary. So I'm going to pull up the invoice here and just think about the journal entry. Let's think about, well, can I put this in terms of debits and credits? What's the debit and credit related to this? Well, we know that accounts receivable goes up for the full amount, and that was the 547.50. This 547.5 goes up for the full amount. We know that sales or income goes up by the amount we get to keep, 500, and I'm going to put it on the credit side. And then the sales tax payable goes up by the difference. So that's basically the sales tax. And then I would think of the other piece as a separate journal entry. Then we know that the cost of goods sold is the debit. I'm trying to make this larger and I did something weird. The cost of goods, let's make that a cap, goods sold goes up by 400, and the inventory goes down by 400. So that's the journal entry. And so notice it's a bit more complex when you have to deal with inventory on this. And so I'm just gonna, so there we have that. We can even indent these. I'm like making it nice now. It doesn't really matter, but I'm just kind of making it look nicer. We could put a little grid line around it. How about that? That'll make it look good. That'll be impressive. All right, so now we have that. So what we're going to do next time is enter this into the system for our adjusting entry. That'll make us correct as of the cutoff date. And then we're going to have to reverse this to be back to where we need to be after the cutoff date to be, logistically correct and keep on pushing forward. So that's what we'll do next time. We'll do the adjusting entry next time, and then the time after that, the reversing entry. That's it for now. Let's get out of here.